state government for the last 2 years of taxes that you pay. You actually get a check. So you can actually wipe out all the taxes you paid in the last 2 years. And if you're lost still, if you have any loss left over, you get to carry forward all business losses up to 20 years and offset the next 20 years of earnings. So you never lose a properly documented business deduction. All the government cares about is that you run your business like a business, which means you try to make money and you document it correctly. And by the way, there's one more thing I want to emphasize. Being self-employed, you have as much as a 700% more likely chance of being selected for an audit. So having good tax records, having good tax tracker isn't just something nice to have. It's essential. It's absolutely essential. Now, my lecturing, I found there's a current tax dilemma. Most self-employed people are either not taking all the deductions they should be taking, which you'll learn today, or they're taking deductions, but they don't have the right documentation. It's usually one, two, or both. And they're leaving themselves open to a lot of significant penalties. I think you'll see that you're not compliant in a number of ways. So what's my agenda? First of all, I'm going to be talking about tax tips. We're going to use to put some money in your pocket, and that's one of the things we're doing. We're going to be then talking about compliance issues, what you need to do to have that peace of mind of never having to worry about an IRS audit because your records will be perfect. How would that feel? Huh? That would be pretty good. Thirdly, we'll talk about how tax bodies and expense tracking application can help you, which we developed. And finally, if I have time left over, I'll go outside and I'll be glad to answer some questions. Okay, a little background about me, by the way. I've been told that this picture that you see is a lot better looking than I am. Somebody's going, yeah, thank you. It's a little younger. A little background about me. I went to school in New York. I was a very practical kid. I figured there are two practical majors in life. I could have been an accountant or a mortician. And I figured I didn't have the charisma for a mortician. So that left accounting. And I was actually pretty good at it. I graduated #2 from the City University of New York. I was salutatorian. I'm a tax attorney. I'm a former trainer of IRS attorneys nationwide. So if you think of an IRS agent, how many people, I'm just curious, how many people think of an IRS agent as a rat? Anybody? Yeah, a couple of you. How many think of the IRS, not the agent, as a somewhat rodent-like organization? Anybody? Good, a lot of you. Well, and those of you who think of the IRS as somewhat rodent-like, I was one of 8 attorneys selected by the IRS to train all of their attorneys nationwide in the corporate tax division. So if I train the IRS attorneys, what does that make me? Rat trainer. Head rat. Somebody at one of my seminars said dead rat. I'm actually a pussycat, but I have some tax on both sides of the podium. I'm president of my lecturing company called the Tax Reduction Institute, which has been over 30 years. I'm a featured tax coach with the Tony Robbins Wealth Seminars. Some of you may have seen me there. I'm a best-selling author of my book, Lower Your Taxes Big Time, and I have another book that just came out that's getting some good reviews called Achieve Financial Freedom Big Time. And I've been a guest tax expert on Fox, CNN, CBS, and so on. And I'm not saying this to impress you. I just want you to know that I know what I'm talking about. All right, we're going to start off with some tax tips. You know, gas is about $3.50 a gallon. I think that's about what it is, from 40 to 60. How would you like to get the equivalent of free gas? Would you like that? Would that be nice? Because when you write off your car correctly, that's what you get. There are 2 ways to write off a car. There's the IRS method and there's the actual method. We're going to start off with the IRS, and it's more conservative. IRS gives you 57.5 cents a mile for every mile you drive for business. So let's say tomorrow you put on 20 miles for business. IRS gives you 57.5 cents a mile. You get an $11.50 deduction. Now, a deduction is not cash. The cash you get from a deduction is whatever tax bracket you're in times the deduction. So what does tax bracket mean? A lot of times we hear this, we don't always know what it means. Is that the average of what we pay? What does that mean when you're in a 33% tax bracket, for example? What it means is what you pay on the last dollar to the federal and state government in your taxes. And if you get a refund, it's what part of that refund comes back, what percentage comes back in saving you the taxes. So it's what you pay to the government on the last dollar you make. That's what tax bracket means. The average American is in the 33% tax bracket when you consider federal, state, and Social Security and Medicare. It could be as high as 54%, but the average is 33%. So if you multiply 33% times $11.50 deduction, that gives you a cash saving in your pocket of $3.80 a day. Now, by the way, if you don't have the right documentation, it costs you $3.80 a day, too, for your car. So here's my point. If gas is $2.50 a gallon, and you get 20 miles to the gallon, aren't you? You're not only getting gas for free, you're actually making a profit. You're making $1.30 a gallon. Everybody see that? And by the way, who determines whether to use, we put 20 miles for business? Who makes that determination? Does the IRS have that burden, or do we? We do. And how do we do it? From a tax tracker or a tax organizer. And that's the IRS method, which is the more conservative method. The actual method is where you take a part of your gas, your oil, your insurance, your wash, wax, depreciation, and that's the percentage of those things that you write off. And again, who determines how many miles you drive for business? Does the IRS or the we? The answer is we do. Now, I do want to mention there's two deductions that a lot of accountants don't even know, even if you use the IRS method. One is you can deduct sales tax on an automobile to the extent you use your car for business. And the second is you can deduct interest to the extent you use your car for business. And that doesn't matter what method you're in, and you can still deduct a part of your sales tax and part of your interest as a business deduction. Many accountants didn't know this. If you file, especially if you use the IRS method, look at your tax return. If you've been in business the last couple of years, see if your accountant gave you a portion of the sales tax and interest. If not, you could file amended tax returns to get that back. I met one person who got back $6,000 from the government. This is not a small number here. Now, what kinds of documentation do you need when you go see a distributor, when you go see a prospect? There's four things that you need. This is what you need to be 100% compliant. Number one, you need an odometer log for the beginning and end year's odometer reading. You don't need it for each trip, just beginning and end of year. Number two, a mileage journal for each trip you take, for each stop you make. Number three, you need the addresses. Where'd you go? So IRS can see if the mileage is reasonable. What was the address? And finally, what was the explanation of the business purpose? Why did you go there? Talked about Canberra Nails, talked about the opportunity, talked about tax planning. Why? If you leave out any of these things, you're not compliant. I'll be honest with you. Gotta have all four things. Now, speaking of documentation, you know, a lot of times we do a lot of personal stuff. We go see our mom, we go take our kids to cheerleading, football games. That's normally not deductible. You know, there's an old saying in Washington, D.C., where I live, where there's a will, there's a William. What I do is I ask myself, if I'm doing something personal, do I have a business stop I can make along the way? Maybe you can see a potential customer or a potential distributor. By doing that, a substantial part of your mileage now becomes deductible, even though you're going to see your mom. And by the way, your mom or dad doesn't have to live where you live. Maybe they live in Hawaii. And you can go visit them, interview some distributors while you're there, potential distributors, and now deduct the trip if you do it correctly. Now, let's talk about cars and trucks. The most you can write off in a new vehicle that you buy this year is normally $3,160 in depreciation. That's only depreciation. You get gas, oil, and so on. However, there are a couple winners that allow you to write off up to $25,000, not $3,160. 25,000, 8 times that number. Who are the winners? New or used qualifying trucks or new or used qualifying SUVs. So what's a qualifying truck or qualifying SUV? You got to do 2 rules. Rule 1 is it's got to have a truck chassis. Rule 2, it's got to have a gross vehicle weight of over 6,000 pounds. That's it. And now you can write off up to $25,000 of the business use of that vehicle. And how do you know whether you have a gross vehicle weight of over 6,000 pounds? How did you ever find that out? I've been saying this for years, and I just found out the answer. When you go home tomorrow or today, you open up the driver's door. In the door jamb is a little metal plate that says gross or net vehicle weight. If the gross vehicle weight is over 6,000 pounds, if you have a truck chassis, you can elect to write off up to $25,000 in business use. Now let's talk about entertainment. You know, first of all, IRS says that you can write off 50% of any meal or that you have for any potential prospect. Here's my question. Who are potential customers and potential distributors in your business?
Everybody.
Everyone are your best friends and those prospects. Yes. How about your next door neighbor? Yes. How about your adult family members? Yes. In fact, I've never met two home-based business owners get together and not talk business. So let me give you an example. In fact, this is how this first started. I asked a commissioner of IRS, I said, how can you, if you have a prospect, how can you ever have a if everyone's a prospect, how can you ever have a non-deductible lunch? You can't. And if you're not writing off almost every meal you have with someone, I would like to suggest that you're leaving money on the table. It's that simple. Now, what's true? What kind of deduction, what kind of documentation do you need for entertainment? You got to have something triggering you to write down the good tax tracker, what I call the 5 W's and an H. Now, what are the 5 W's and an H? Who? What's their name? Sandy Botkin. What type of entertainment was it? Was it a meal? Was it a business gift? Was it, what was it? Why? Be specific. Talk about it for generally else. Talk about the opportunity. Where? Went to Chili's Steakhouse or Outback Steakhouse. When? What was the date? And finally, how much? Who, what, when, where, why, how much, and you are bulletproof. You'll have that peace of mind of never having to worry about an IRS audit again. What is that worth? Okay? And by the way, I want to emphasize something here about entertainment. You know, a lot of people, how many people here watched a big sporting event like the World Series or the Super Bowl or the World Cup or one of those big events, Olympics? I don't know if you know this, the company pays like $1 million a minute to advertise. It's a huge cost. Most self-employed people don't advertise on the World Series or the World Cup. But your form of advertising is value marketing. When you entertain, that's how you're advertising. And it obviously pays to advertise because you're promoting your business in pursuit of a profit and you're offering proof that you're running your business like a business. So entertaining is encouraged by the Internal Revenue Code. All right, there is something called in the Internal Revenue Code associated entertainment. I want you to write this down. I want you to write down associated entertainment, put an equal sign, and write down the word fun. Fun. This is where you're going to a movie. This is where you're going to a play. This is where you're going to a ballet. Do we have any golfers here? Anybody here play golf? Golf's an expensive sport. So if you write it off, you're having twice as much fun. IRS says that you can write off 50% of your fun as well as 50% of your friend's fun if, and this is IRS talking, not Sandy Botkin talking, if you talk business in the same 24-hour day as the fun. Does that give you enough time? So let's take an example. I went out, let's say I go out with Jennifer to her home and talk about business. And then an hour later, we go out with her husband and we go to a play. Is that talking business within the same 24-hour day? Answer, yes. Let's say that Jennifer and I go out to lunch. And we have lunch, we talk business, and they go, well, Jennifer, it's such a beautiful day. We say we go to a hockey club, we go to play golf. And Jennifer says, well, you show me how to play out, I'll go with it. She might have a 300 handicap, but she's going. Is that talking business within the same 24-hour day? In other words, we have lunch, and then we play golf. What do you think? Yes. Here's the problem. Who has the burden of proof of showing that we talk business during the same day? Does the government or we? We do. And how do we do it? From our tax tracker, our tax organization. Everybody get the drift here? You know, you all have homeowners insurance. Why? Because if your house burns down and you don't have it, it's a disaster. I know everybody in this room has auto insurance. Do you not? Because if you get into, you don't use that every year, but if you get into an accident without auto insurance, that's a disaster. Your tax tracker is your audit insurance from the government. It is exactly what you need to keep the government off your back for the rest of your life. That's exactly what you need. And unlike auto insurance, you get paid every single year and you never get canceled. So what kinds of documentation do you need for entertainment? Same thing. 5 W's and an H. Who, what, why, where, when, and how much. That's it. All right, let's talk about a home office. How many people in this room have heard that if you claim a home office deduction, it's not worth it, and you're probably going to get audited? If you heard that, please raise your hands. Oh, I'd say at least half of you. Wow. What if I were to tell you in 1999, Congress liberalized the home office rules for self-employed individuals? Now, my question to you is this. Why would Congress do that if they didn't want you to take it? Second thing is we actually did a study, actually it was a friend of mine who did a study, and we found that people who claim the home office versus those that don't claim home office have the same chance of being selected for one. So my point is, if you're eligible, I'm here to tell you you're crazy if you don't take it. So what is home office and how does it work? Let's assume this is the floor plan for your apartment or your home.